Hello, welcome to another Hershey Financial Advisors economic update video. So today I just want to talk a little bit about how we started off the year in 2024, kind of talk a little bit about 2023, and in order to get the build up for explaining the 2023-2024, we need to talk about 2022 and the whole way back to 2021 and 2020. So obviously we had COVID, market went down a lot in 2020 for a month and a half, really. It started in mid-February, February 19th, and dropped until the end of March. The government did an extraordinary effort in setting up multiple stimulus. The Fed dropped rates. The market actually did quite well the rest of the year. There was some volatility there, but did quite well. We had supply shortages in 2021, but we still had a really good market in 2021, and really, when you look at on paper without looking at day to day, 2020 was a good year. So it recovered well. It really depending what asset classes you were looking at for 2020, but it was a good year for it was really a good year for most asset management firms, and certainly did very well in 2020 here at Hershey Financial Advisors. So 2020, kind of a mixed bag. Some stuff did better than others as well, but overall pretty good year. 2022. The shock of the interest rate increases, one of the fastest, steepest increases that we've had in modern history, happened in the Fed, central banks here in the United States and other central banks as well, increased rates. That meant bonds got hit. And to give a scope of how bad bonds got hit, it's often been compared to the worst bond market since the Civil War. So you're talking significant amount of the interest rates went up so fast, and the interest rates were so long for such an extended period of time since 2008, that you're looking at a significant drop in anything that was out the yield curve more than a couple years. Even the 2-year had, which means the 2-year Treasury, which means the bond is going to last only 2 years, so it's not going to be as interest rate sensitive. The only thing that really did well in that time period was the ultra short term that was issued, 3-month, 9-month bonds. So, or even shorter. So, long story short, that was a tough hit for stocks in 2022 as well. But relative to what stocks' normal volatility is, it was not nearly as much. That wasn't a really heavy downturn in stocks. A heavy downturn in stocks would be plus 50% drop for bonds. And when you get into the teens, that's you're talking 10 years worth of gains or more that bonds have got hit. Where for stocks, that was really most portfolios really only lost about a year's worth of gains. You're not that far into 2020 before you come back to where you gave back your returns. So that's kind of how we measure the volatility and the risk and the downside peak to trough. So looking forward, 2023 is an interesting year. It was probably the most that I've seen, and from what I could tell, that economists and market analysts got wrong. They expected the stocks to be hit and bonds to take off. Bonds did not take off. In fact, bonds continued to slide and do quite poorly. And when I say bonds, I mean most bonds. Again, not the ultra short term that were continuing to go up because the Fed was raising rates up until the middle end of the year of 2023. But this is really important to understand, because until the very end, so the market went up on a very narrow scope of a couple technology. They called them the Magnificent Seven. They made up most of the gains from last year, from 2023. But what's also very important to understand about that is there was still volatility, and in the general broad stock market was up in the summer, then dropped down again in the end of October, and was starting to head down, and then did a quick reversal when the Fed suggested that they were done with raising rates. The market priced in 5 to 7 drop cuts in the next year, which would be this year, 2024. They are not looking like they're happening in the near future. That's still up to debate. But at this point, where we're at this year is looking back at it, that most of those gains held in the broad market and even the bond market. The bond market's given back a little bit, maybe 1.5–2% in the general bond market this year, since that we moved from the consensus of multiple cuts this year to, at this point, depending on who you talk to, we might not have any cuts this year. The economy's still coming in strong, jobs are coming in strong, productivity's up, which is positive, but we really could see that the rest of the year, there's only one, maybe two Fed cuts of 0.25%. So that takes the Treasury ultra short-term Treasuries, in other words, the Fed rate, from about 5.25 down to maybe mid-4s. But at this point, the Fed doesn't seem to be really anxious to cut if the economy stays strong. Long story short, the economy is not reacting the way it normally does to those high interest rates, and there's a lot of reasons for that. As far as the stock market, again, very driven by a few stocks. Tesla's dropped off that magnificent 7 year to date. It's down. In fact, over the last year, it's down. You're looking at Apple, that's struggling a little bit. Just announced that they're not going to have they gave up on producing a car, that they spend a lot of money in research and development. They also are talking about some issues they're having in Europe, some penalties they're paying for competition, and also not being fair in competition, and China. China is another story that I'll just bring up that is really important to understand, and what we're looking at here at Hershey Financial Advisors. China has had a significant housing bubble, real estate bubble, not just housing. And it's really hard to say how many years it could take to unwind, but if you compare it to our housing bubble, and if you compare it to some things that Japan was through in their overall bubble in 1990, which just literally recovered this year from the 1990s, where they hit the stock market and coming back up to a parity of where it was in 1990. If you compare our previous bubbles in the real estate and policy mistakes, China could struggle for quite some time. We also have some technology issues right now, and distribution and production issues between China because of security, and I think that will continue to happen no matter who's the president. I also think there's some things to pay attention to with real estate. Commercial real estate continues to be hit with these interest rates. They are directly tied to interest rates. They work different than residential. You don't lock in a rate for 30 years with commercial real estate. They're usually shorter periods of time, and when cycles that you have to refinance. Banks also have been under stress last year. We're seeing that pop up a little bit more this year. We'll continue to watch that very closely. And residential real estate, we think, is a very big component. The ratio between income and the affordability of home is as stretched as it was in the Great Financial Crisis. And so we're watching that. We're paying attention to that. We're looking at how everything kind of works together. We are very focused here at Hershey Financial Advisors on the upside and the downside. So we want to make sure the portfolio has an appropriate amount of strategic asset allocation that doesn't drastically change based on what's going on in the economy, and tactical that does significantly change from week to week or month to month, and to play defense and offense, take advantage of the changes. One of the things we also think is really important is the speed of change is happening so much faster than it used to. Market cycles. I was just talking to a client, a company that's really doing well, like NVIDIA, or cryptocurrency. The difference between going up drastically and going down drastically, those cycles are happening quicker. And I think the magnitude of bubbles, certainly in this environment, we could continue to see boom and bust. The environment is pretty vulnerable to that. I just saw an article just this week. There's more family offices. There's more people with $100 million of net worth. It's more than double from before COVID. So there is definitely a lot of money, a lot of resources, a lot of wealth that was created post 2020, and we're paying attention to that, and we're paying attention to what happens to that in the future, and how markets react. And so again, we're very focused on the upside and the downside and balancing those two out. It matters a lot, not just how much money you make, but how much money you keep. So thank you for listening to this economic update. We look forward to putting these out on an ongoing basis. If you have any questions, please call and contact our office and schedule a review. It could be in person if you're local, on Zoom, or just a phone call. But we appreciate you, and we look forward to talking to you soon. All right, take care.